Hey everyone, welcome back to Corporate Decoder, the place where we dive into the exciting world of corporate filings. Today we are tackling Mesoblast's latest report. You might think a biotech company specializing in stem cell therapies would have a pretty straightforward story, but trust me, this one has enough twists and turns to make your head spin. This report is a mixed bag of regulatory wins, financial juggling, and some pretty serious risks. We will break it all down to understand what is really going on with this company, so grab your lab coats and let's get started. So what's Mesoblast up to? Well, they are a regenerative medicine company focusing on stem cell therapies. Think of them as trying to fix the body with its own building blocks. This report covers the 6 months leading up to the end of last year. First, a bit of housekeeping. Joseph Swedish, a non-executive director, retired. It is always worth noting leadership changes as they can signal shifts in strategy. Let's get to the financials. The company had a loss before income tax of almost $48 million. That's a big number, but losses are common in biotech where research and development costs are massive. Looking at the revenue, it's about $3.2 million for the period. It mainly comes from commercialization revenue. That means they are selling some product, but remember this isn't a huge income for a company with such big losses. The company lost about 4 cents per share. Now let's talk about where the company is spending that money. Research and development clocked in at about $21 million and manufacturing hit almost $15 million. Big expenses, but that's the cost of playing the game in biotech. Something interesting is their equity-settled share-based payment transactions, which reached about $15 million. This is basically stock options and incentives for employees. This can be a good thing as it aligns employees with the company's success, but also dilutes the value of shares for current investors. Scrolling down to the balance sheet, their cash and cash equivalents are roughly $38 million. That's a drop from about $63 million last year. Burning through cash is pretty standard for a development stage biotech, as they need capital to run trials and operate. A massive chunk of their assets is intangible assets, worth over $574 million. These are things like patents and intellectual property. However, these assets are very hard to sell if the company goes under, as they rely on successful products to become worth anything. The warrant liability, what they might owe, comes in at about $13 million. It is worth noting what they owe since it might impact how much funds they have available. There was mention of an offering completed in January of the next year, 2025, that raised $161 million. It is worth noting this happened after the period covered by this report. They have a huge amount of deferred tax assets not brought to account, over $143 million. If they ever turn a profit, this could significantly lower their taxes, but there's no guarantee they will actually be able to use them. Now let's scroll back up to some more interesting details. The loss before income tax increased pretty substantially compared to the year prior, from $32 million to $47 million. The company highlights some important events that occurred during this period. Firstly, RYONCIL was approved by the FDA. This is huge for them. It gives them their first commercial product. They also revised their short-term incentive structure, giving employees options instead of cash. This saved them almost $7 million in cash, but added about $8 million to share-based payment expenses. There was also a shareholder class action that was settled. Thankfully, their insurer covered it so it didn't impact the bottom line. They mention milestone payments for their partnerships. I am not going to get into the weeds, but revenue recognition is very important. Revenue can only be recognized at certain times. They earned around $100,000 on royalties. Not a lot, but every little bit helps. They go over their income tax, which is honestly an accounting nightmare. One interesting thing is the research and development tax incentive, which brings in some money from the Australian government. This is an important thing for them to leverage. Now let's move on to the risks, which are always important. They are exposed to currency risk since they operate in multiple countries. They try to manage it, but fluctuations can still hurt them. The borrowings are a point of focus because of their structure. Cash repayment seems to be a major use of capital. The company says that it has resolved a class action. The company has trade and other payables, but it has to be paid. Cash outflows should be handled with care. There is a big focus on debt, which implies the importance of revenue and the relationship with Oaktree. They have a lot of debt. Now onto the financial risk management. They have various exposures like currency and interest rate risk, but the big one is liquidity risk. Basically, can they pay their bills? They manage this with forecasts and capital raising. Okay, so what about that warrant liability? It looks like the warrant terms were adjusted in relation to their American Depository Receipt (ADR) program. Let's talk about the income tax. The effective rate is not what it appears because it's impacted by deferred taxes, which can change. They are also not bringing to account a ton of deferred tax assets. The fair value measurements involves a lot of estimation. It is worth to note that they have been remeasuring all this during the year. Changes in assumptions could cause a huge change in the debt position, so investors should be aware of possible changes and how they might impact things. Finally, it's important to mention some events after the reporting period. They completed a private placement of shares and will issue some shares to one of their partners. The business is only one segment, so that makes analysis a bit easier. It is very R&D heavy. Now let's get to the risk factors. Remember that management is on record stating these risks, so they have weight. The first one is straightforward. They have been losing money and might never be profitable. They may need substantial additional financing, which may not come on favorable terms. They mention potentially favorable regulation, which can be a bit of a gamble. They are working with very sick people who might just die anyway. IP litigation is always a risk. Employees might break rules and hurt the company. Acquisitions can go wrong and hurt financials. Australian takeover laws might make it hard to acquire the company. Trading prices might be volatile and could hurt the stock. Being a foreign private issuer can make comparing the company with US peers difficult, since they report in different accounting standards. Okay, that is it for the main points in this report. Now it's time to add my 2 cents. Mesoblast is a high-risk, high-reward play. The approval of RYONCIL is a big deal. There is no doubt that it validates their technology and gives them a revenue stream. However, they are still burning a lot of cash and rely heavily on this one product succeeding. Their manufacturing partnerships are a point of weakness. They outsource this critical piece and this leads to risks. Also, their debt level needs to be watched carefully. It could become unsustainable. There is potential here. If they can successfully commercialize RYONCIL, get additional approvals, and manage their expenses. But it is not a safe investment by any means. A big risk that is worth keeping an eye on. Thanks for watching. If you enjoyed, please subscribe, like, and comment. It helps me know that you enjoy seeing these analyses and encourages me to do more.